Just one or two principles, guys. When something is 95% VATable, there's a thing called the de minimis rule, and the de minimis rule rounds up to 100%. So basically anything that's 95% or more generally gets rounded up to 100%. Okay. Now, let me just explain what a change in use is. Okay. So what is a change in use? Okay. So I have this asset. And what happens? It's used 40% for VAT. And then all of a sudden, it changes to 70% for VAT. Okay. So there's a change. Let me explain what normally happens in an organization as far as this is concerned. So beginning of the year, guys, what happens is, or actually, let's rather do it as last year. Last year, residential rent, 3 million, and factory sales, 7 million. So 10 million, and it's 30% exempt. 70% VAT. That's what it was last year. This year, residential rent has stayed at 3 million, but my factory sales have gone through the roof because I make sanitizers for people with COVID, and I've made 27 million rands worth of sales. Okay, so my new sales is 30 million. So at the end of the year, it's 90% VATable at the end of the year. And this is what we call a change in use, because at the beginning of the year, I had 70% VAT. And at the end of the year, I've got 90% VAT. Okay. And I have a change in use. Okay. Now, let's go through the rules for this, for a partial change in use. It says a partial change in use is where we have a taxable supply and it stays a taxable supply. Like this, 70 becomes 90. It was a taxable supply. It stays a taxable supply. Guys, examples include 40 to 70 or 100 to 20 or 35 to 60. You're not allowed to have any 0% because what does it say? Taxable supply, and it stays a taxable supply. 0% is not a taxable supply. So it needs to have numbers in it. What is the rule? It says the cost of the asset must be greater than or equal to 40,000, and the change in use must be greater than or equal to 10%. If both of those things apply, then we're going to have a change. What are we going to do? We're going to say it's a 20% change. It's gone from 70 to 90 times by lower of cost or market value times by 15 over 115. That's what the formula is. So percentage change times lower of cost or market value times 15 over 115. So that's there. Let's have a look at a description of a partial change. It says a company registers the category B VAT vendor with the March year end, sells long-term assurance, which is exempt, and short-term insurance, which is taxable. In the previous year, 60% of sales was assurance and 40% was insurance. So it was 40% VAT. In the current year, a virus epidemic causes many people to lose their jobs and cancel their short-term insurance. During this year, long-term insurance was 77% of sales and short-term insurance was 23%. So at the end of the year, there was 40% VAT. It says the company owned two assets, a building that cost 1,150,000, including VAT. Current market value is 1,725, and a computer that cost 5,750, including VAT. There's a partial change in use from 40% to 23%, 17% movement. What do? We say 17% is greater than 10%, plus we only need to do something for the building, not for the computer, because the building is the only one that costs more than 40,000. And it says for the building, VAT needs to be accounted in the year-end VAT return, because we only do this once a year at year-end. There it is, time of supply, the period in which the year-end VAT return falls. Okay. And what are we going to do? We're going to say lower of cost or market value, cost 1150, market value 1725 over there. So lower of the two, 1150 times 15 over 115 times by the 17% move. And that's what we call a partial change in use. Again, on the VAT legislation sheet, there is a tag that you're going to put for change in use for partial, which will remind you of all of these rules. Greater than 40, change must be greater than or equal to 10%, what the formula is, all of that you will have in your tag sheet, and you can use the tag sheet to do that. And that's what we call a partial change. It happens once a year at the end of the year. We look at our sales for the year and we see whether it has moved more than 10%. If it's moved more than 10%, we need to do a VAT adjustment. And that's called a partial change in use. Okay. The next thing is what we call a total change in use. Now, guys, what's going to happen with a total change in use? Okay. There are two types that we do. You can see there's two diagrams. So effectively what this one is where there's a total change in use, where you go from exempt to VATable. So this one is going from, say, 0%, and then it goes to VAT. It doesn't need to go to 100%. It could go to 70%, or it could go from 0% to 100%. It could be, okay? So this is where you go from 0 to a VATable item. So let's look at the example here. It says a company with a December year end has one asset, a block of flats with 50 units that is let out for a minimum of 12-month period to tenants. All these rentals are exempt supplies for residential accommodation. The company has a August year end. So guys, it was 0%. It says on 1 March, a decision was made to use 40% of the flats as holiday flats, renting out flats for short-term periods to holiday makers. These rentals are VATable as they with the provision of commercial accommodation. So I've gone from 0% to 40%. It says the flat had a cost of 2.28 million, including VAT at 14% when originally acquired by the company, and had a market value of 5.75 million on the date that the change of intention took place. The market value at year end was 6 million. What are the VAT implications for the change in use? So guys, the rule is time of supply, immediate. It's not going to change. The moment I make the decision is the moment I do the VAT adjustment. Please remember, for a partial change, we only do it at year end. So partials are done at year end. Total changes are done immediately. And what is it? Okay. Guys, it depends on whether it's an input or an output. Now with this one, it's an input. I didn't claim anything when I bought it. Therefore, I want to claim input now. I'm going from 0% to 40. So it always works on the screw the taxpayer principle. It works on the screw the taxpayer principle. And what's going to happen with it, guys? Because it's on the screw the taxpayer principle, what happens is it's on lower of cost or market value, because you want to make the input claim as small as possible. So what are we going to do? It's a total change, 0 to 40. And what is the total change? It's the lower of cost, 2280, or market value, 2280,000. Guys, I don't care that it was bought at 14% VAT. That is not what the current VAT rate is. You're always going to use times 15 over 115 here. And how much input VAT can I claim? 40%, because it's now used 40% for VATable purposes. And that is what we call a total change in use, where we go from exempt to VATable. Now, guys, when we go from 100% to 0%, okay, or 70% to 0%, it's a slightly different rule, because I claim VAT on it I've got a special set of rules with this. Now, again, guys, the value of supply and the output and the time of supply, guys, immediate. So remember, what's going to happen, guys? I just want to do an example quickly. So remember I did that example where I had a guy with a pharmacy. It says Mr. A owns a pharmacy and is registered as a monthly VAT vendor. It says the pharmacy trades as a sole proprietor. Mr. A has a date with his girlfriend, and upon closing the store on 12 Jan, he took a box of condoms off the shelf in the pharmacy. The condoms originally cost 23 Rand, including VAT, when buying them from a condom supplier. In the pharmacy, the condoms were normally sold for 46. The pharmacy submits VAT returns monthly. What are the VAT implications? So it's gone from 100% business to 0% business. Now remember, it's always on screw the taxpayer principle. So in this case, it's an output. Because it's an output, we use market value times by 15 over 115 times by the movement chart's gone from 100% to 0%, 100%, which would be 46 Rand times 15 over 115 times 100%. And there'll be a 6 Rand VAT adjustment over here. You got to do that immediately, and that's what's going to happen. Now, please just remember, okay, if I've got something that's gone from 70% to 0%, what are we going to do? And let's imagine the market value is equal to 10 million and cost was equal to 6 million. What are you going to do? Output VAT. Now, remember what I said to you when we did apportionment. Output VAT is done on 100% times 10 million times 15 over 115. And what is input VAT done? I claimed 70 originally. My input VAT now will be the 30% times by 6 million times 15 over 115. Because remember what happens? Output VAT is done at 100%. And if you haven't been able to claim all of the VAT on the goods before, you can now claim the portion of input VAT that you claim. If the machine was destroyed, guys, if the machine was destroyed, there wouldn't be a input VAT claim, and output VAT would just be on 70% based on what I've done. But you've got 3 types of change in use, guys. You need to know them. Partial, 35 to 60, 100 to 20, 40 to 70, no zeros. Then you've got 0 to something, and this is how you do it. And then you've got 100% down to something, which is this one, and this is how you do it. Total changes in use, you do immediately. Partial changes in use, you wait until the year-end VAT return to do that. Okay, and you guys need to just bear this in mind. Again, guys, what's going to happen is I will post a video for you. But, guys, if you have a look here, I've got the VAT question on apportionment and change in use. And there's a solution to it that's just below it. You guys can practice it. And you can look at the video that I will post there for the solution itself. If you want to just have a look at a nice discussion question on VAT apportionment and change in use. Again, this is an exam question that has been set, okay, for another varsity. For a varsity, it's at proper exam level, and it'll show you whether you understand how to do apportionment and change in use if you want to practice on one. The next chapter, cessation of business, going concern, and leasehold improvements.